What the New York Times is talking about this morning. Welcome to Futures Now. I'm Jackie DeAngelis. This is a very special show. We are calling it Boom or Bust, and we are going to talk about what is going on out there right now and bring you some answers with an all-star panel joining us today. First off, we've got Faber Schiff. He is coming to us from Connecticut, and also Jim Murio coming to us from the floor of the CME in Chicago. Dennis Gartman, the commodities king, he is on the phone from Virginia. We'll talk to him in just a bit. But before we talk to the rest of our guests, I want to bring in our first special guest. Marc Faber is calling in from Thailand. Marc, always great to have you on the program. I'm just going to throw this first question out to you. Boom or bubble? What do you think?
Well, I think it's a colossal bubble in all asset prices, and eventually it will burst, and maybe it has begun to burst already. And obviously, I've been wrong in the sense that I expected a correction to occur over the last 2 years. It hasn't happened since October 2011, when the S&P was at 1,074. We've gone up in a straight line without a larger correction than 11%. And I think we're not going to have a correction, but we're going to have a bear market.
And what do you think triggers the bear market? I mean, we've seen some declines as of late. Is this enough to sort of get that going, or is it going to be something else?
I want to tell you, you never know what will trigger a bull market and what will trigger a bear market. You only know it after the fact. When the markets bottom out, everything looks horrible, and nobody can think why the markets should go up. And when markets peak out, nobody can believe that it could go down. And we have now an environment where everybody puts faith in central banks printing money, and that therefore asset prices cannot go down.
Let me ask you this, Marc, to correct me if I'm wrong, but I believe the actual definition of a bear market technically is a correction downward of 10% or more. Is that what you're looking for, and how quickly do you think it can happen?
I look for 30%.
Okay, 30%. That is a steep bear market.
Yes. I mean, it's a minor correction. If you can't buy something without the expectation that it goes down 30%, then don't even get out of your bed in the morning, because we have within markets a lot of volatility.
You know, Marc, you've been calling for this for quite some time. Obviously, you've taken a very bearish view. What do you think makes it different now, where we're standing here in July 2014? What's the difference now? You know, you mentioned the Fed propping up the market. It appears the Fed will probably continue to do so.
Yes, the difference is that valuations are much higher, and contrary to what most investors and strategists expect, I don't believe that the global economy is strengthening. I rather think the global economy is weakening.
When you talk about valuation, I'm assuming you're talking about valuation of the S&P 500, for example, but a lot of people are saying, you know, it's time to really not necessarily focus on valuation, but look at companies, for example. Earnings expectations for this season are quite high, and companies appear to most analysts right now like they're going to meet or beat expectations. So if that's the case, and if earnings go well, and if corporations are doing well in this environment, does valuation really matter the way it used to?
Well, I've never met any analyst who predicted a downturn or a significant downturn in earnings, except for analysts that work for short sellers. And the fact is simply that earnings have been boosted by stock buybacks, not by revenue growth. And another fact is that earnings are grossly inflated because we have artificially low interest rates. So I wouldn't rely so much on the analyst expectations as of today.
And what do you think the chances are? You know, there is some buzz out there that the market is sort of has gotten a little bit top heavy, perhaps. Maybe the Fed might consider raising rates sooner than expected. Do you see that in the cards?
Actually, in my scenario, where the market goes down, I don't think that the Fed will increase interest rates at all. But there are other issues that may put the weight on the market and keep prices or push prices lower. I think we have in the White House a very poor president, and that may lead to some political issues in the U.S. domestically. B, we have numerous geopolitical issues to consider, and C, we could have potentially a much higher oil price.
Mark, I want to bring in another voice on the market here. We do have Faber Schiff with us today. Peter, a question for Mark right now.
Well, I think we're saying the same thing, just with a different accent. Although, Mark, do you think, though, if the Fed tries to blow more air back into this bubble, and I would agree with you that it's a bubble, but if the Fed is determined to fill it with more air, don't you think they may succeed in slowing down the process, and so the nominal decline in stocks may not be nearly as great as the decline in the value of the dollar?
That is entirely possible. If you would increase the asset purchases by the Fed, say you go from asset purchases of nowadays, say, I don't know, 35 or 40 or 50 billion dollars a month, you go to 500 billion dollars a month or $1 trillion a month,
that
everything will be inflated. But I believe, and this is what I have to say, the only sector that stands out, in my view, as attractive, and I said it at the beginning of the year in a Barron's interview, are the gold and silver mining stocks and platinum and palladium. And whereas the S&P is just up 6% this year, the GDXJ, the junior gold mining
I agree with you. The
index,
only place there's not a bubble is in gold, and that's the only place that most people on Wall Street think they see one. They're oblivious to the actual bubbles, but they're overlooking the value in gold and gold mining stocks.
The biggest bubble.
I definitely thought Peter was going to say that. Mark, you agree too, but I also want to bring Dennis into the conversation here. Dennis Gartman, if investors are out there and they are looking for a flight to safety right now and they want to get away from the stock market, is gold the place to do it?
Well, it depends. Probably, yes. Probably, this is going to be one of the rare times that I will actually agree with Faber Schiff on almost anything. But, yeah, I think gold mining shares are probably inordinately inexpensive by almost any measure. Normally, I would say go buy gold itself. I'm not particularly bullish of gold. I'm not a gold bug. There are times when one should own gold. There are times when one should have zero amount of gold. This is probably a time when you should have some, but for the public, I think looking at gold mining shares, which have underperformed gold bullion over the course of the past 2.5 years, and only in the last 6 months has that spread between bullion and mining shares begun to move back in favor of the mining shares themselves. Probably this is the first time when you can say, go buy the mining shares. And if you're going to do that, make sure that you buy the big names. Make sure you buy the ones that are going to be liquid and going to be around. Buy the Barracks, buy the Homestay, buy the ones that have been here for a long time. Whatever you do, public, please don't go looking at the
Homestay hasn't been around for a long time. I think they were bought by Barrick a long time ago. They were.
Yeah, I understand. But look at Barrick, look at ASA, look at the larger names that have been around for a long time. The public tends to get involved with fly-by-night mining shares, and please stay away from those.
Gentlemen, I will bring it back to gold in just a minute, and we will get to a gold trade later in the show as well. But I do want to bring it back to the stock market here, because a lot of investors are looking at this market. They are kind of concerned. I want to sort of go around the horn and get an idea from each of you. You know, we've seen situations before where we think that the bubble is going to burst and it doesn't burst. Are we ill-advising investors right now to sort of fight this market and be short when it could increase a little bit more? I just want to get everybody's take. Mark, you first.
Well, first of all, I'm not advising that people be short the U.S. stock market, because I'm afraid of a lot of money printing. I don't know that it's going to get up to $500 billion or $1 trillion a month, as Mark is suggesting, but the Fed could certainly go to $100 billion, $150 billion, and so I'm more worried about the downside risk in the dollar. And so I don't want to short the market, because when you do that, you're exposing yourself to the dollar. I'd rather be long the things that will go up as a result of all the money the Fed prints to stop the stock market from imploding or to stop the real estate market from
Peter,
going down.
I mean,
so I'd rather
made the
own
point.
gold. I'd rather own certain foreign stocks than be short the U.S. stock market.
Right, and you've made the point several times on this show and elsewhere as well that you are a gold lover. But, Mark, I want to go back to your thesis because you are calling for a market correction of 30%, a true bear market. Obviously a very bold call. You've made that call before. You have been wrong. So I ask you this.
I didn't say 30% before. I said correction of 10 to 20%.
Okay, so this is
Actually,
the first
Mark,
time
you
you're
did say
saying 30%. But, you know, really for investors who are out there, they've watched this market go higher and higher every day. I've watched it myself. Every time we introduce the show, we say record highs on the S&P 500. We can't believe that we're saying it again. Are we ill-advising people to not really ride the momentum wave here?
Well, the point is the indices have gone up, but I would challenge you. Most people haven't made any money this year because, first of all, the Russell 2000 is flat for the year. And a lot of stocks are not up, but down meaningfully, from Facebook to Yelp to Twitter to LinkedIn and so forth. So a lot of people have actually lost money in this rally. The indices have been driven by very few stocks. If you look at the 12-month new highs, it's a very limited number.
That's true, but I think most people out there, especially with volumes being this low, we can assume that you really don't have that many retail investors in the market. Certainly, maybe not like you once did, but you have to assume that funds are diversified when they're buying.
Yes.
Yeah, that's because they're spending all their money at the supermarket.
The retail investors, they've been killed after March 2000, and then the Fed killed them a second time after October 2007. So I would say the Fed has done a great job at eliminating wealth from ordinary people. And you asked me about bubbles, and I want to return to this subject. The biggest bubble is in the ego of the academic knowledge of Fed governors. I've never seen a group of people as ignorant about real life, but talking in academic terms nobody understands, and wobbling around as the Fed's members.
All right, so if you're worried about that, Marc Faber, are you willing to go out on a limb here and tell me that you're the most bearish that you've ever been?
No, because I'm aware that, as Peter Schiff said, they may print and print and print. But that's why, in this environment, I always advocate you hold about 25% of your assets in cash and bonds. By the way, this year, long-term U.S. government bonds have outperformed the stock market. You hold some in stocks, and you hold some in gold, and some in real estate. But the shares I hold are in emerging economies. And by the way, this year, Vietnam, Thailand, Philippines, Indonesia, India are up between 15 and 25%.
All right, Marc Faber.
Yep. You know, the U.S. market is the laggard so far in 2014. You know, 2013 is probably the last year the U.S. stock market is going to outperform emerging markets or other developed markets in other countries. But I would disagree with Mark. I see no reason to hold any U.S. Treasuries. Yeah, you might squeeze out a little bit more in the rally, but it's certainly not worth the downside risk, especially since all they amount to are IOU dollars. And if the government's going to print a lot of money and repay its debts with near worthless money, why go down with that ship? I'd much rather own the foreign stocks or the precious metals and don't lend any money to the U.S. government, because either they're not going to pay you back or they're going to pay you back with money that buys very little.
Yes, Peter, I agree with you. I think eventually sovereign debt will be pretty much worthless. But I have to have a diversified portfolio for me and my clients. And so I hold some U.S. dollars, and I really can't see how the euro would strengthen a lot against the U.S. dollar. It may strengthen somewhat, but not a lot. because if the euro strengthens meaningfully, they're going to print as well in Europe, the same in Japan and so forth. So for that reason, I hold gold.
All right, Mark, we are going to have to
think we
leave it
all
there.
do.
On that note, I agree with you.
We
Yes.
all do.
But there are other
We
indebted
know you two
sovereigns.
agree
If you
on
want to
that
buy
one point, for
sovereign
sure.
debt, you can look at other countries that are better credit risks than the U.S. government.
Who's a better credit risk than the U.S. government? Please, come now.
Just about anybody.
Gentlemen, I want to move the conversation along. Mark, thank you so much for calling in, but I do want to get to...
Thank you.
I do want to get to a trade here. Jim Uriel, come into this conversation. You heard what Mark had to say. Dennis is piping in. Of course, Peter has his view. What is a trader doing right now with the S&P 500?
Okay, first of all, I am short-term negative on the S&P 500, but I don't believe we're in a situation where a bubble's bursting. The two bubbles I've seen were characterized by mom and pop and next-door neighbors and uncles borrowing to buy tech stocks and borrowing to buy homes. Those are the people who have to react when the margin calls happen. We've seen a lot of institutional leverage, but we haven't seen that sort of leverage too. That being said, and with all due respect, I am somewhat negative on the market just because we've come so far so fast. So I am short-term negative. I think we have a bit of a correction. I've said this before. Sometimes it pans out, most of the time it doesn't. I want to be a seller at 1959 SEP S&Ps with a target of 1943 on the downside. If it trades 1969, that's where I'd wash myself out.
All right, let's go ahead and bottom line.
Just because Main Street hasn't joined Wall Street's party doesn't mean it's not a bubble. I've been calling this the bubble for the 1%. You're right. The average investor is too broke. He's spending all of his money at the supermarket. He's got nothing left over for the stock market. But we do have a bubble among speculators. Private equity, hedge funds, they are loaded up on property and they're loaded up on overpriced stocks. This is a bubble. Everybody doesn't have to participate to make it so.
Yes, and here's my point is that those people react differently when the time comes to sell it. And the popping of the bubble won't be as violent if it's institutional investors with deep pockets.
I disagree. These guys are going to cut and run. I mean, they're not going to ride this thing down. And I think especially in the housing market, individuals had mortgages. But the hedge funds, the private equity guys, they don't have mortgages. They don't need permission of the bank to do a short sell. They can just dump their properties on the market, and they will.
Guys,
I think the Fed is going to have to come to the rescue with a lot more money printing to stop that process from unraveling.
Yeah, Peter, a lot of issues to get here. Just hold it for a second. I do want to bottom line this trade here, wrap up the conversation, and then we're going to get to your favorite topic, which is gold. But for now, Jim is selling the S&P at 1959, targeting a drop down to 1943. Since each point counts for $50, this trade risks $500 to make $800.